Good morning, everybody, and welcome to the latest in the IMAP investment webinar series. Today we're going to, and for the rest of the week, we're going to be talking about what to me is one of the really central strategic drives for the way in which advice is being transformed. And that's the way in which individual advice practices adopt wealth management as a key strategic issue. Over the next few days, we're going to take a number of approaches to this. Today, we're fortunate enough to be joined by two presenters who I'll let our moderator introduce, who come from a high net wealth orientation. On Wednesday, we'll have two presenters whose advice business starts with an accountancy background. And then on Friday, we'll have a couple of large practices talking about the strategic implications of making wealth management central to your whole commercial and business approach. Before I hand over to Paul Forbes, our moderator, let me just say a little about a couple of things coming up for IMAP over the next month. Managed Account Awards. This is now the fourth year in which we'd have offered the awards, and I'd encourage you to participate in either the asset class categories, the licensee category, innovation, or our new ESG responsible investing category. This is a chance to have your expertise recognised, and it gives us a pool of finalists and winners that we can use through the next 12 months, people who we're delighted to showcase in events such as this webinar series or in our conferences. On the 2nd of June, we'll be hosting a webinar with Adrian Kwa, who's putting together a submission to the Quality of Advice Review. And we'll be talking about what that review is designed to achieve, and our view within IMAP about what quality of advice means and how it can best be delivered. How can we deliver better advice to more people at lower cost? But most importantly, in June we'll have our 3-conference series, Advice in Action. Let me just say a little about the topics that we'll be covering. Although IMAP is, of course, a managed accounts organisation, and managed accounts play part of, we'll have a prominent part in our conference. This is really about the way in which advice businesses are responding to the changes that are thrust upon us by both regulatory change and just the transformation that technology and natural evolution is bringing about. I'd encourage you to attend. I think you'll find that the range of topics covered through the day really is quite interesting and insightful. Now, before I hand over to Paul, if you want to ask a question, at the bottom of your screen, you'll see a Q&A button, and Paul will be moderating that. So now it's my pleasure to introduce Paul Forbes. Paul is the CEO of the Australian Advice Network, personally has a long history as an advisor, and his own business, Robina Financial Services, is part of the Australian Advice Network. So I know from the briefing sessions we've run that Paul brings great insight into this topic. And it's my pleasure now to invite Paul to take us away.
That's great, and thanks, Toby. And hopefully we'll be bringing some topics to the next 3 webinars, which for listeners out there, give you some insights into the journey some of these businesses have had, but also some of the things you need to look at if you want to pursue different tracks. So we're joined today both by Andrew Tracy from Jeb, Toby Ware, and Scott Fletcher from Woodbury, both really substantial businesses. But the journey to where they've come from, where they've gone, I think is really going to be interesting to both boutiques and practices out there. I'm going to start off by letting both these gentlemen introduce themselves, and I'll pass to Andrew first, and then to Scott. But then we'll spend a little bit of time talking about Woodbury's and Scott's business before we move into the JB Ware business and their journey as well. So on that, can I pass to you, Andrew, and just give the listeners a bit of a background?
Thanks, Paul, and good morning, or good afternoon, everybody. Andrew Tracy, what are the key numbers? 37, 27 and 13. 37 years in the industry, 27 at JB Ware and 13 years running our external managed account business. I head up our discretionary business at JB Ware, which is part of our premium offering of managed discretionary individual mandates for larger than 20 million clients. Also our managed account business, and I look after our trading desk, markets desk, which looks after our execution derivatives and a lot of our offshore execution. And also that includes our syndicate business, ECM, DCM type flows that are coming through from our partners there. So I might pause there and throw across to Scott.
Thanks, Andrew. Paul, good afternoon, everyone, as well. Scott Fletcher, I'm Chief Investment Officer at Woodbury. Woodbury is a boutique multifamily office into private wealth business based in Sydney. We've been going for about 37 years. My own career is a bit younger than Andrew's at 30 odd, well, actually 30 this year. So my background's in institutional funds management predominantly over those 30 years with a range of portfolio and strategy and client-facing type of roles.
Terrific. All right, thanks, John. All right, so Scott, it's an interesting looking into your business. I'm sure some of the people watching you actually had a look at websites and other bits and pieces. So Woodbury's is a true multi-family office and larger and works with ultra high net worths. Can you talk a little bit about that journey and that decision? So whether that was a conscious decision or whether that evolved, and we'll just talk through that.
Yeah, sure. So it's an interesting topic, this one, because I think, you know, the journey of the business as a whole, you know, has gone through a lot of evolution from really the start of the industry back in the insurance days in the mid 80s, all the way through the evolution of all parts of the development of the industry. It used to be a business of a few thousand clients back in the 90s, and then it was really more of a conscious decision, Paul, in terms of developing out our client base, looking at where our skill set was more strongly aligned to, and really at the end of the day, well, at the start of the journey, actually, it's what the clients want, and how, and it's not just what the clients want in our context, it's how could we profitably serve that. So we found ourselves through different centers of influence. This is sort of pre my time in the business, but back in the 90s. But it was really about the clients that we were attracting, and it was generally in that high net worth, and then moving into ultra high net worth. Now, ultra high net worth means different things in different parts of the world. So, you know, Australian version, you know, some people might even say 5. You know, well, our definitions have changed along the way as well. And you know, in talking today, I confess, you know, we're fellow travelers. You know, we haven't got all the answers at the end of that progression, but there's a lot of similarities that hopefully people can benefit from.
Cool. I think the one of the challenges for a lot of businesses, we have a small portion for a lot of boutiques. We have a small portion of our client base which probably could slip into high net worth. I think ultra high, or if you're looking at talking about $150 million, it's probably a different example for a client. But as a chief investment officer sitting inside that business, obviously that has its own challenges, because I think that they're expecting more complexity, and they're probably expecting more tailoring in individual portfolios. Is that how you look at it? Or?
Yeah, it's almost a continuum. From, you know, it's more the retail end, and then you move into the sort of mass customization, to borrow an American term. I don't know if that's an actual term, but it's one I've heard used a lot in my previous life. So you can't over tailor at certain points in the client continuum. Once you get beyond a certain level, though, the expectation is definitely there that they will be able to speak to someone who runs the investment program, They will be able to speak to you about investment complexity in some instances. In other instances, they're not investment technical people. And so you have to navigate that in the middle. In terms of the complexities you mentioned coming into a boutique advice business, you're quite right. There's the book Men Are From Mars, Women Are From Venus. I don't know if it's true or not, but anyway. But there's one that should be written for funds managers and advisors as well. They're often two different worlds. And so the first sort of port of call was coming in to the business, and we had to be very clear about the next stage of growth and development. So at every step of the way in the business, every few years, there was a very clear business plan or business case put forward as to what's our next growth curve to jump. It's the transition from one growth curve to another that is the most difficult thing, because you're not there yet, but you're taking an additional risk to jump curves into the next big opportunity. But from an investment point of view, I just look at it as what you would see in an institutional investment team. For example, you would have a strategy team, you would have a research team. Andrew will have those in-house, but in a boutique sense, we don't need all the headcount if we can access that expertise in a cost-effective way using specific consulting inputs that we subscribe to. We don't want to rely on a fund manager or anything for soft dollaring or anything like that. What we get, we pay for. And that's really important to us in terms of our independent side as well. But if you break that down, strategy, research, portfolio construction, implementation, portfolio management, monitoring, review, the same sort of the very familiar cycle. We had to be brutally honest in what we thought was a commodity and what we thought was a real value add. And then over and above that, we had to make a determination as to what we do very well to an excellence level, and what others will do more excellently, put it that way, than we will. And that's where we determine what we outsource for input and what we insource. But at the end of the day, regardless of what we outsource, we're still the quarterback in the middle. And so we have a tendency to recruit and to engage staff that are quite experienced at what they do, and have experience in areas that we outsource to, so that when those inputs come in, we can filter and analyze them and assess them, and then put it in a customized way for the family office type clients. Yep. But we'd also leverage that for other clients at the private wealth end as well.
And I think from an AFSL point of view, so there's two quite different models out there. The one which is probably a specific family office, and then there's a multi-family office. So for your AFSL, maybe can you just explain to those who are watching the whether or not they're living under the same rules as boutique practices and advisors out there?
Yeah, so just to clarify, in terms when we say family office, a large family office will start at generally in the high hundreds of millions to over $1 billion. And what we're really talking about, we've been very specific that we know where the big end of town play. We know the pros and cons of that engagement. So we have a very specific sort of level which would really equate to a small family office. In other words, clients or families that aren't big enough to cost efficiently meet that sort of 1.5% sort of cost level to 2% sort of cost level that's thrown around by all the reports into that part of the business. So we work together with different families, bring them together where it's more cost efficient for them to access our effectively solution platform, if I can put it that way, of services in concert with other families as well. But we don't just that's the high end continuum, and that's the increasing bulk of our business. But we also have private wealth, C-suite, professional services clients with a high degree of complexity usually, and not just investment. So if you mention the term wealth management, there's different definitions to that. But our firm started from a wealth management starting point, and then outsourced multi-manager many years ago to a particular multi-manager provider. But then since that time, we've really brought in an investment capability inside, but still use elements of outsourcing.
Right. I will move down in a second, but just one last question for you, Scott. If you looked at you specifically, we've talked. There is some. You've got to look at outsourcing and looking for quality solutions outside of the business. What core skills do you think would be intrinsic to your business? So, what would you say are skills which you want to make sure you do control within your four walls?
Yeah. So at the heart of it, we sort of moved from a personal CFO model, which is a phrase that sort of goes back a while. This is almost 20 years ago. And we moved from that type of approach where your core skills are really, obviously the client relationship, the strategic advice, and the project management. Project management for us, as well as the strategic advice, obviously, is a major capability. It's really important in the high net worth to ultra high net worth space.
Okay, cool. All right, Andrew, we might just move to your business if we couldn't. We will come back, Scott, and we'll actually just explore a little bit more about how you manage the investments as well on that side. But Andrew, JB Ware's fantastic history, obviously a very strong business which has been around for a very, very long period of time, and you've been there for 27 years, so you've seen some of that change. Obviously, continuing to evolve. So, based on the conversation we had the other day, it's most people would think of JB Ware's as being a stockbroking firm. But do you want to maybe talk a little bit about where that firm has gone, or what's happened over the last 20 odd years and where you find yourself now?
Sure. And it's probably worth taking a step back and just looking at that history. I mean, JB Were was a founding member back in 1840 in the Melbourne Stock Exchange. So there's 180 odd years of experience that sits within the walls of JB Were. So there's a lot of long-serving clients on our book that have been there for a while. And if you look at the pitch book that our advisors would have in conversations with clients, that we're managing about 60 billion in FUM across our platform and across the CHESS system. The average advisor at JB Were has been in the industry for 22 years. Myself a little bit north of that, but the average is 22 years experience across the industry, and average of about 14 years experience at JB Were. But the book itself, I think, is about a third of our clients have been with us for over a decade, and a third of the FUM that we look after, that we advise on, and it's all individual personal advice based on each individual client's risk profile and investment objectives, is about 30% of those assets are in portfolios of greater than 20 mil. So we've gone from being a transactional broking house back in the sort of that whole period, and probably in the last 20 years moved across more to the assets under management, wealth management model, the complete asset allocation across the book. And that journey itself, we're probably a little bit more advanced than some who are maybe listening on the call, but there's been some points during that. Look, I definitely remember the day when Goldman Sachs, when they were a minority shareholder at JB Were, announced to the world and to JB Were that in their New York office, Goldman Sachs were no longer paying their stockbrokers commission on Monday, and on Friday, about 500 years of experience walked out the door in the Goldman Sachs New York office. And on Monday, you're only paid by funds under management. So if you ever want to change a business model, that's the Goldman Sachs way of doing things. See you later, boys. Here's the new one. If you like it, stick around. If you don't, see you later. It probably took us a bit longer than that, and we did it more softly and enticing and encouraging advisors and clients down that path. And there's no doubt there is a much better alignment of interest with advisors' interests and the clients and the firm by going down that path. And I think the clients get a much better outcome than an individual stock-based domestic exposure, which had a limited life expectancy in itself as the world was moving into a much broader, moving into a wealth management space. We've still got work to do. We're still systems we still need to do, where we've got a big presence in the managed account business. I set up the external managed account on 4 external platforms about 13 years ago. We have an internal managed account, which probably had about $1 billion in it at its peak. And that started in about 2000. So well before external platforms were bringing out managed accounts. JB Were had an internal managed account with internal and external managers on that. Sally Campbell's been our gatekeeper for the last 22 years, and she was very much in control of who came and who went on our APL across that book, and has done a fantastic job over the course of that time to protect and preserve that wealth. And that managed account business we just relaunched in November last year onto one of the things I'd say to people out there is do your due diligence when you're looking at your business, agree on the strategy. Moving across to funds under management, I can tell you, was not a popular call in a stockbroking firm at the time. That's where Evans and Partners came from, Paul Heath and Coda Capital, those that wanted to focus on direct equities kind of up and went, but the firm in itself and the core of its client base all moved in that direction and have seen the benefits of that.
Yeah, so actually, I was going to ask you about that, but I think that you probably answered that question in regards to the getting advisors or substantially well experienced brokers to move on that journey with you, but building managed accounts obviously can build a more consistent solution for you.
The managed account piece, I think that if you're looking at, and Dean Campbell and I have run this external SMA business for the 6 years Dean's been there, and a bit longer for myself, but that discussion with a senior advisor in an external dealer group, a lot of them would be on the call. They are experts in what they do, and they consider themselves the stock picker of the organisation, the one who manages the portfolio, the investment committee that makes the decisions. A lot of those senior advisors will take longer to recognise and realise the value of managed accounts and the scalability that brings to a business. Some will try and blend their skill of stock picking, mid-small caps into a portfolio, into that solution. But I think you'll find the younger generation are the ones that adopt it sooner, faster and smarter. They want something that's efficient, compliant, show me how I can scale up my business and do more business. And they may not necessarily have my experience or senior advisors' experience in direct equities and be across every stock in those portfolios. And, to the senior advisors, if you're out in the marketplace in IFA land and you want to sell your book of direct equities to another party, I can tell you'll get a much better value, a much better multiple for a book of managed accounts or managed funds than you will for a book of direct equities, because the next generation coming through will want to do this slightly smarter, slightly more efficiently. And, I've been banging the table internally on managed accounts at JBWere, and the investment trends data that came out last month talks about, if you're a direct equity advisor and you move across to use managed accounts, 17 hours a week you're saving in time for admin, statements of advice, keeping up with markets, executing, reporting, holding clients' hands. That was 15 hours a couple of years ago. It's now up to 17. We all know there's more compliance and more costs out there to serve, but we've progressed towards be wary of the unintended consequences of a royal commission or any legislation. The cost to deliver advice, we all know it, has gone up, and we've actually done an external piece in JBWere to go out and quantify what our cost to serve is. And we've decided that the best place for us to focus and deliver value to what our clients want is at the wholesale end of the market.
Yeah, it's interesting. So you're consciously now wholesale. And actually, one of the questions from Tom Dorr, hi Tom, was around that. So I think both businesses would largely be looking at those sophisticated wholesale clients as being your prime, or is the direction you've taken the business. Is that fair?
Yeah, post Royal Commission, we recognise that servicing, as much as we've got many retail clients and love them dearly, but the cost and the compliance risk of serving those clients was significant. And then when you look at the revenue piece on the other side of the equation, that was less than significant. So, to quote a number to you, JBWere, and a lot of these were dormant one-off accounts. We, as brokers, we all had people set up accounts to get access to different IPOs like Telstra and the like over the years, but we've actually just closed and referred elsewhere 70,000 accounts at JBWere under our right client policy. And that some have gone to NAB Trade for those who are self-directed, which is the right place for them. That's a good outcome. Others who wanted advice in that sort of sub-wholesale space, we have referred those across to a panel of brokers, again, who specialise in that area of the market. So difficult decisions to make. Some clients, I'm sure, were less than pleased about that conversation. And to be honest, it was some of the conversations that we had with clients were, and we all know that we don't manage every dollar for every client that sits on our book, and some will have other relationships in the market. When we had that conversation with some of our clients, they actually decided to close other broking firms and move some more money across and decided to stay on the book. It wasn't done as a fundraising episode, but by any means, there was a lot of.
Not going to complain if it works so well. That's good.
I'm sure there's advisors there who had lots of tense conversations, but there were some positive outcomes. But yeah, unintended consequences of royal commissions and government intervention.
Yeah. So I'll move back to Scott, but for both of you, I'll just talk a little bit about resourcing, because I think that's probably an interesting point for people who are on this particular move, whether it's to wholesale or whether it's simply the addition of internal management expertise. And also the topic is that advice to wealth management, which is in itself is an interesting question, because I think you'd still say you're in advice land, and wealth management's always been part of it. But say, Scott, from your point of view, the internal resources you'd need now to manage the investment portion of the business, I suppose, and by investment I'm talking about whether it's direct equities, managed funds, or probably anything beyond. So
yeah, sure. Yeah. So if you think of the portfolio as a whole across public markets, private markets, and all the different asset classes and so forth, we don't do direct equities in-house, and it was a very deliberate decision that we made a long time ago. So ours is more of a strategic role, and also these days in terms of where there's family portfolios where there's a gap in their portfolio, that's very specific, almost like a completion fund that fills the gap. We will project manage a solution in there as well, where we'll select the research, select the managers, then construct the investment solution and implement that for them and review it on an ongoing basis. But we don't do the down to the security level, say like an Andrew Wood, a JB Weir, or other brokers that we use on our panel. So we very specific in the types of things that we will in-house and the types of things that we will not, because it's all about bang for buck, and also we're a business, and so there's a commerciality aspect to it in terms of what does the client need, what solution set does that require, and then how commercial is that for us to provide that. And so that's why we've put upper limits on upper and lower limits in terms of clients. In the investment side itself, we have very strong relationships and subscription relationships as well, with everything from investment strategy and input on a global basis through to direct equities, where we have specific clients that require an ongoing portfolio management for direct equities. We'll still oversee the strategic asset allocation, for example. We will set up and review or generate and review the commercial terms between our business and then the outsourced direct equities provider that will service our clients in that specific things. But there's really strong parameters and ring fencing that goes on. And that's part of the thing when you're outsourcing. This would be the same for any business listening in today. You've got to balance that against who's a faux competitor and who's not, right? And so we take a fair amount of time in terms of our panel to work out the strength of relationship. Usually it's a long-term relationship, or it's been something that's been referred to us by a long-term relationship. But we're really careful about the businesses that we outsource to. On private markets, for example, we have probably half a dozen local doorways into very large overseas general partner type of firms. Don't need to advertise them here for them. And so we can access pretty much what you can access through a large capability. It's just that we don't have the tie. We don't have the tie or the tag to AUM. So at the upper end of our client base, we actually break the nexus between strategic advisory and assets under management. We don't need it. And so pricing was a really important thing we had to work out in that regard too.
Cool. Just last one before I leave you there, so the strategic would include, obviously, you're choosing people to partner with, but are you also are you setting an overall asset allocation as a strategy for these clients, and therefore some of that you may actually use ETFs and some passive funds for those which you can't see a lot of value added by active? Is that fair? Or? Yeah,
that's right. So total portfolio management means a couple of different things in info space, but effectively what we look at is we're fairly agnostic in terms of the vehicles that a client uses. So on our investment menu, if I put it that way, we will have ETFs, managed funds, we'll have private market opportunities, things like that. We will have elements of direct equities, of course, for various clients. But yeah, so SAA is central to what we do for the client, but we take a different approach. So most of the industry, or the inspo market in particular, will get goals and objectives and things, and then suddenly miraculously a pie chart appears that's going to solve 5 or 6 different types of conflicting objectives and so on. What we do is we have taken out of an institutional asset consulting sense and gone bottom up in terms of goal discovery and preference selection. So we actually break down the cohort of goals and objectives into identifiable sub-portfolios that are linked directly to that goal and objective. And then we weight those in discussion with the client according to their needs personally. And then you'll end up with a pie chart at the end of the day, but it's built from the bottom up, specific goal sets and cohorts, not down from the top into their existing pie chart of the manager. So that's the difference in the way that we do it as well.
Cool. All right. And Andrew, we've had this conversation, but obviously when you built this a much larger business, but over a period of time, you look now in your internal expertise, you've got a significant team there doing your asset selection. So
yeah, I think we've got our markets and investments group. It's a team of about 32 professionals inside the walls of JB Were that effectively tailor the research to what we need the output to be for our clients. Now, if I go back in the day where JB Were had their own research department and had 120 odd people in research, and they were ranked #1 in the country, that research on individual stock levels is a commodity in my view these days to a certain extent. You can pick that up from Morningstar, from a broker, we use UBS and Moelis as our preferred providers in that space. And we've had great relationships with them, and also Goldman's and Citi over the course of time. So getting access to that material, we tailor our research to what our clients actually want. And at JB Were, we always put our client first, and we aim to give them the confidence to do what matters to them. Now, whether that be in a philanthropic services space or whether that be in an investment portfolio, it really comes down to, and Scott, you mentioned direct equities there. There was a time where that's all we did. And I think that's probably a little bit of a misconception out in the marketplace. Scott and I do have had many decades together where we've been a client and a broker, but that sort of era of direct equities for JB Were still exists for those clients that want it, but I think it's progressed much more beyond that now. We've got ESG, responsible investing, that sits under Gillian Gordon there in that division, and built out the headcount under that. The 32 that sit across our markets and investments groups doing strategic asset allocation, some model portfolios, manager research. I'd mentioned Sally Campbell before, and then that philanthropic services team with John McLeod, Shamal Das, they're probably managing 10 or 11 billion dollars across Australia and New Zealand in that space. And you've probably seen some of their stuff, the cause report, the support report, producing that output that our clients in that space want to read. And John McLeod just recently published the top 50 givers that you'll all pick up from the AFR magazine. You'll be able to Google that and see that. That'll give you some insights into what's happening in that space. And that to me is what the clients want, and that's really what we've been aiming to deliver.
Yeah, I think that number there, the 32 there, would probably scare a few people if they're trying to build their own teams internally. But I think it's a good point though. You've direct equity is only part of what you do. So, and I could see that would be when moving those advisors to moving those brokers to advisors, and now changing how they think about managing money. Is you're building your own portfolios? Do you also use external managers in there as well? Or
yeah, again, it comes down to the end client. Some clients might want the direct space, and I want 100% direct. It's the lowest cost, most tax efficient way to run an Aussie equity portfolio is to run it directly.
Yeah.
but then you need to have a client who is sufficiently skilled in being able to cope with corporate actions, capital raisings, listings, delistings, everything that goes on, making decisions on an intraday basis. And normally it's people who've got quite a large letterbox, I find. If you've got 40 stocks in your portfolio, you're getting annual reports and bits and pieces. So platforms, having the right systems and platforms in place to make that experience pleasant for not just the client themselves, but also for advisors and the efficiency for businesses as well.
One of the questions, and I'll sort of put this to both of you, is there a difference between wealth management and funds management? Okay, so I was interested that when Toby first put this topic together, I thought, well, no, we all do wealth management, but I think it's fair to say that so I wouldn't mind you actually looking at that. Maybe if Scott, could you start with that?
Sure.
Yeah, because I think from advice land, it could be different. Is that fair? Or?
Yeah, absolutely. So it's one of those questions, the old economist joke, you ask a number of economists and you get more answers or more responses than you ask. It is like that. So in thinking about this topic, when we first discussed about it, my view coming from funds management was, what do you exactly mean by wealth management, right?
Yeah.
And so to us, we started in wealth management anyway, because it's a range of services across a whole range, a more holistic range of services like financial planning and tax and banking and estate planning, and that to us is an investment as well, but that to us is wealth management. And so it just really depends, in each one of those spokes, whether you have it in-house, like some firms larger firms will do that, a lot of that in-house, or whether you sort of outsource elements of it. But it's definitely, in my mind, wealth management is different to funds management, because funds management is more about the investment management capability, whereas wealth management is more in advisor land. And where you come across more of like wealth management in an inspo space is more in asset consulting, for example, which won't have the same sort of spokes, but it'll have different spokes that need to be covered for a client. But funds management is definitely just about, well, not just about, but primarily about the investment management side.
Yeah. And Andrew, you sort of, where are you on that one?
Yeah, look, don't disagree. I think if you're looking at wealth management, it's more about the execution, the implementation, the relationship, and the understanding of the effectively the know your client piece. Funds management, managed funds management, I think they're interchangeable, and I see those as tools that advisors can use to implement that wealth management relationship. And I don't think there's one's a naughty word and one's a good word. I think they both are interchangeable, and they both have been interacting in our marketplace for decades.
Yeah. No, I don't think there's negatives in either. It is an interesting point, though. I think one of the things which building managed portfolios, I think there's the question I often have is are you building to compete with? So you've got a balanced fund. Are you trying to sit at a table and be top quartile, second quartile? And I'd probably see this more in Scott's, because you're more a specialised business. You'd be actually looking in Woodbury's to say, right, let's build a portfolio, but when you're looking at that specific client objective, it may be that what they're wanting from their investment management piece could be a lot of downside protection, happy to give up some upside. And I don't know if you two would see that as different inside your businesses, Scott. So.
Yeah. So the objectives that we work towards are definitely more on the absolute side of things, because they're quite specific and bespoke. Now, having said that, human nature being what it is, there's also like the holy trinity of benchmarking, which is the absolute return objective, which is CPI plus, or a downside drawdown of X, or whatever the case may be. Then there's usually a comparison to your own benchmark if particular advisors or investment managers want to deviate away from their strategic allocation. But then there's the peer one, right? And so even as absolute as you want, we've seen this with real return funds. You can be as absolute as you want in terms of your return objective, that you can get the client to agree. But when that is underperforming by a long way, a comparable type of fund or advisor, all of a sudden peer relative becomes really important. So we focus on the absolute objective first, because that's out of all the discovery that we've done in the preference setting and the goal selection with the client. At the end of the day, that's what they've signed up for, to meet their long-term objectives. But you still have to keep an honest eye on performance, because peer relative performance, because if you don't, your clients will. And so I don't, it's primarily one, but you also need to have an element of a couple of aspects to your benchmarking.
Yeah. Andrew, are you pretty much in the same camp on that, or?
Yeah, look, we have those sort of models in-house. We don't run them as managed accounts. We have those for advisors as a guide for what a balanced growth type investor might look at. And it really comes down to that relationship between the advisor and the end client. They need to have that conversation. Just because we make an SAA change or we make an individual stock change in a domestic JB income portfolio, as an example, that doesn't mean that every client that's in that portfolio will follow it. Some have got CGT issues, some have got cash flow issues, some don't want to change it. Someone's father might have worked for Westpac, so they don't want to sell the stock. I remember that one distinctly from a client back in the day, but they're not set hard and fast, but they are tools and a guide for advisors, and each advisor will have that one-on-one relationship with a client to implement, have the conversation, and that is the decision point. Managed accounts and models will add efficiency to that. And looking at JB Weir's business, where it is now and where it's come from, I think the use of managed accounts or scalable, more efficient ways of executing is only the journey that's just beginning for us now. It's you've only got to see what's happening in the external managed account space. You look at the numbers from IMAP, investment trends. That market is growing at 35% compound, and it looks like it's going to accelerate, not slow down. So I think those efficiency tools, having run a desk that dealt purely with advisors like those on the call, I know advisors will hit efficiency and capacity constraints at about 100 to 150 mil of direct equities. So if you're growing a book, I wish you all the best, but when you get to that stage, you'll be market constrained or system constrained. One is that you have a great back office and everything works well, and you need to have that to get to that 150. And if you're going to be market constrained, you get the banks recapitalizing like they do every cycle. After GFC and after COVID, all the banks recapitalized. So did a whole lot of overgeared industrials. I think there was 100 billion raised in the GFC that was recapitalized. That was the first tick for me when I had my biggest client call me and say, Dicko, I'm closing my business to new clients because I just can't keep up with the corporate actions. And that was a screaming call from advice in IFA land to get efficiencies and scalability in their business. And that it's taken us a while. That was back in sort of 2009, but I think managed accounts have grown from that decision. Yeah,
I think there's a couple of points on there that probably gel with a few people on the call. But I think that just from my own point of view, we've used managed accounts now since 2015, not doing direct asset selection, but certainly looking at underlying managers. And I still look at it through the eyes of the AFSL. So from an AFSL point of view, the fact that we have some consistency across the group in regards to managed accounts means I know a fair portion of clients' funds where they are at any given time, but also if there is a change to be made, I know that's being passed through all clients at the same time. So you do remove some of the legacy risk, which I think sits in the traditional.
I remember Dean and I on the Zoom very early and post the correction in the COVID drawdown in March. And the one thing that we could demonstrate to clients was if someone was invested into our JB income portfolio, I can show you the 24 stocks that are sitting in that portfolio. You can look at them. You can see the ones which are not requiring capitalization. A managed fund didn't have that transparency. And I think that in those uncertain times, in extreme market conditions where volatility is around and you've got clients picking up the phone and worried that they might be an XYZ manager and, are they overexposed to mid caps, small caps, green caps, you name it, they're those ones there were, that's why we retained all of our FUM during that period. And if they needed to raise capital, they'll go and raise it from a black box somewhere else in a managed fund environment.
One of the questions we've got, and it probably applies to both of you, is do you provide detailed performance and attribution reporting to each managed account client? I know that that's for most of us with managed accounts, it's probably something which is actually pretty much standardised. I'm not sure. I think if I look at, I'm assuming, Scott, yours would be more the holistic, let's talk about the whole portfolio. But if you're running individually managed accounts inside yours, Andrew, you'd still be reporting to those clients based on those performances.
Yeah, correct. And I just noticed a question there on sort of share purchase plans and scrip offers and those sorts of things. In our internal managed account, we have the ability to tailor and exclude and do all that. So we managed to retain a lot of the individual share ownership benefits internally because they've got their own HIN. Where you get onto an external platform and a broader one, that is the one disadvantage of a managed account is you lose the shareholder benefit. God forbid it's a Coles Myer discount card that burdened many brokers for decades for everybody buying 500 Coles Myer shares to get their discount. But yeah, a lot of those benefits will disappear in a sort of most large managed fund, large platforms externally.
Yeah. Andrew, Scott, sorry, any on yourself? Are you having to really? Well, you'd be doing attribution analysis because you're talking about what's happening inside the portfolios.
Yeah, absolutely. Yeah, so we utilise a couple of large systems that we bring in house that helps with not just portfolio construction, but also monitoring and review and attribution. So it's quite sophisticated these days what an advisor can access. I remember, Morningstar back in the pre-Direct days, but even in Morningstar Direct used to have a bit of a reputation, I think quite unfairly, as more of a retail sort of, it's not really, high level institutional type of analysis. But these days, Morningstar, Lonsec, I won't just pick on one. There's a range of systems out there, I'll be fair, that have really increased their attribution capability, risk models. Now, most advisor clients will not be worried about factor attribution and things like that. But it is very important if you're putting portfolios together, whether it's direct equities, managed funds, ETFs, including private markets, that you know your strategy, you know your exposures to get that strategy and reflect it, and then you worry about the managers. That's the way we do it. Strategy first, exposure set second. So what sort of asset allocation, regional, what sort of industry selection, and then we end up with the managers that are tools to implement that strategy. So these days, most advisors have access to some pretty good systems, a lot better than they were, that will help in that regard. And we're no different. We utilise that pretty heavily. That means we don't need the internal sort of headcount of 20 back office people. We can utilise a lot of those systems pretty well.
Yeah. We've got about 10 minutes left, so I might actually get you both to think a little bit about 2023 and beyond, and probably start to think about where you see some challenges in portfolios coming up. But there was a question there on pricing, but one thing I would say to listeners, which I found quite interesting, is that when you start this journey, if you've got a reasonable amount of FUM available over the medium term, I found good quality, because we largely work with managers. I found managers were more than happy to talk about fee negotiation. Obviously, they have their own rules, so it's almost starting to build an institutional relationship. But I think all that advantage can actually be very much there for the underlying client. Scott, are you pretty much on the same boat there?
Yeah, we utilise a combination of different implementation options, of course, but the more you can, the bottom line is more you can aggregate and scale, access scale. Obviously, the more discount or you can get on different managers and so on. But in our case, and I guess in most people's cases, if not all, it has to feed through to the client to be an advantage.
Yeah, that's right.
You know, it's got to go straight through, and that's the way we operate. Where we get rebates, things like that, or pricing advantages, you know, we flick that back to the client.
Yeah, Andrew, any discussion on pricing at all in regards to?
We have the same setup with our scale. We managed to negotiate and leverage some pretty good refunds, rebates for our wholesale clients. Definitely that all gets passed back through. The one point I'll make on pricing is you need to know your starting point, and that's probably where we were a little bit late to the game at JB Were in knowing what our cost to serve individual types of clients were. And you know, if I was sitting in IFA land, I'd have a fairly detailed breakdown of my business, which no doubt you all do. I'd look at the strategy, make sure you decide as a firm where to go, because I know when we went to funds under management, there wouldn't have been an advisor in the broking house that wanted to go to funds under management. And you know, advisors will vote what is good for their self-interest, and you know, we're no different across the industry. But the firm acted in what is in the firm's best interest, and that shift across to, you know, the full wealth management offering versus a pure Aussie equity broker has been, you know, the decision that's, I think, saved JB Were a lot of pain in that period of time, and we've managed to compete and retain a lot of the names in our book that may have been tempted if we just stayed as a pure Aussie equity broker. And some of you may recall Goldman Sachs having a period of time where they were a minority owner of JB Were. We needed to make that call to give us global distribution in what we were doing, because a lot of our big corporate clients like BHP, Amcor, were two names in the JB Were ECM book that were going into dual listings and international listings back in that period of time. And for us to remain relevant to them, we needed to globally get that distribution. So hence the tie-up with Goldman's for 7 or 8 years.
And Paul, just on the pricing as well, as to just sort of build on what Andrew said there. Yeah, for advisors, there's obviously the one of percentage-based versus flat fee sort of structures. And in our business, you know, we went from, you know, the old commission sort of stuff in the late 90s, but in the early 2000s, we'd started moving well into flat fee for service. And you know, he took some hits and mockery along the way, leaving things on the table, but you know, it's looking all right now. But yeah, but right now, even with an investment offer, we approach it from more of a consulting fee type of approach. So a lot of the time that we spend, if you want to think of big rocks in transitioning from a smaller size Woodbury into one that incorporates some investment capability. After you get through the vision and the structure and the resourcing and the operating model, you have to talk about pricing. And so we spent a lot of time fine tuning an internal pricing model that was, you know, I think Andrew mentioned, every advice business will pretty much know its financials pretty well. We had to drill right down on ours and know where we were profitable and where we were not. And so pricing, along with license, own AFSL, was one of the key waypoints in the evolution of the business. So that was a challenge. That, you know, bringing an internal investment capability into a fee-for-service business does create some pricing tension, and it took us a while to work through and work that out. We got there in the end, but I would admit that was a challenge.
Yeah.
Well, one thing that I'll just throw on the back of that comment from Scott is that one thing that really surprised me when we did our due diligence for a lot of our managed account piece and some of our other offerings is how open and transparent some of our competitors have been.
Yeah.
So if you actually pick up the phone, and I know some of these guys quite well, you pick up the phone, have a conversation, have a bite to eat for lunch with these guys. And, you know, when you were rolling out your managed accounts, what are the things you wish you did differently? You know, where were your mistakes? What would you change? How would you do it? What was your pricing? What was your advisor's response? And I was amazed at how open and collegial our competitors were on that space. So don't be afraid if you're an IFA out there and sitting in your own office worrying about your own issues. They are industry-wide issues, and don't be afraid to pick up the phone and have a conversation with a friendly competitor if you have such a thing inside your dealer group. It doesn't have to be outside, but we definitely went outside because we wanted to get a broader industry input into our DD before we moved down that path. And, a lot of those guys are good mates and I consider them close personal friends, but they, no commercial things were entered into, but their feedback on what worked and what didn't work and saved me and Dean and our guys a lot of time on rolling out what we rolled out, and just by learning from others' mistakes.
No, very good point.
We make mistakes too, but we'll pass that on to the next guy.
That's right.
Yeah, you're better off learning from others' mistakes, aren't you? In terms of external input. Yeah, and
doesn't stop you making your own though.
Oh no, they just want that book to be smaller. That's all.
Look, we get short of time here, but the last little one for me then. So there we go. We've got a new government. That's all done. So we'll see what happens in the next couple of years. But if you're looking, I mean, one of the lines I heard recently, which I thought was actually a very good line, is that the next 10 years in investment markets are going to be very different to the last 10 years. The removal of financial stimulus, geopolitical instability, which is probably always there, but it's particularly focused at the moment because of the Ukraine and Russia and relationship with China. And we've got rising interest rates, with some inflationary pressures. The hunt for yield won't change. So if you're thinking a little bit about, and maybe just some final thoughts on both your businesses on how do you have, in your business plans, how you're adjusting, or is there something in there which you're happy to share with the listeners? I'll start with you, Scott, and finish with you.
Yeah, sure. Yeah, I mean, it's a great question. 10-year crystal balls, the track record of that. I used to work in Treasury Department at the start of my career. Guilty. So, there's not a, but you need a starting point for that from, like as a long-term equilibrium. I would suggest that, in terms of when we were doing portfolio strategy reviews in our investment committee, even, 2 years ago, or, just around the COVID time, yes, there was all that pump priming fiscal expenditure and, excessively loose monetary policy and so on. But the 2025 period, like a couple of years out, the middle of the decade was always it's got to come home to roost at some point. And so I think with Ukraine and just pouring a bit of fuel on the pre-existing trends of inflation and interest rates, as we all know, as the questioner asked, that sort of brought it forward more into 2023, 24, and because markets are forward-looking animals, it's going to bring it into now, of course. So what we're doing in portfolios is, because we have different types of portfolios for different client situations or sort of circumstances, where we've had more pro-growth type of exposure profiles in portfolios. It's not that you run for the hills, because you've got to stay within your risk profiles, of course, that you set up with the client. But it's probably better time to just pull the head in if you've got any particularly large. I'm not saying we do, but if you have any particularly large regional positions of US, non-US, if you have any particularly large style factor exposures of pro-value or pro-growth, the way these styles and these types of exposures are moving around and swapping in a very volatile environment at the moment, would suggest that because the cycle's deteriorating, so if you go through a cycle score, value, yeah, right, we know what markets fall, value gets better, but that's more of a long-term signal. But it's more about the cycle scores now. It's more about monetary policy cycle, growth cycle, earnings cycle, and they're the ones that are deteriorating, of course. And so that's what, sort of leads to a bit of, let's just, pull the exposures in a little bit, not head for the hills or, put up the white flag by any stretch of the imagination. But just, it's not the time to be taking extreme risk in portfolios in either an asset allocation or an exposure sense.
Without going through the global macro summary, I'll just let you know recently, in the last couple of weeks, from an SAA perspective, we've reduced our growth exposure and increased our defensive asset exposure. We had walked away from sold government bonds out of our portfolios probably 18 months ago. And interest rates have obviously hit the lower bound and started to bounce back up and reprice. So we've added those back in as a defensive measure into portfolios because we believe that they're offering an attractive yield now, and that the role they traditionally used to do in a portfolio, being your saddlebags and the ballast in your portfolio, is now more akin to what the pricing of those sort of bonds are in the marketplace. So that's been a real change. And I'd have to say we're probably more cautious now than we have been for, any time since the COVID drawdown. So we're, if you look at the recession modeling that you see around the world, it could be 15, 20% chance of a recession at any time. Scott mentioned the middle of the decade, 23, 24 for us. If the risk of recessions in the back half of that period of time starts to increase closer to 35 type %. So that is an elevated position, and we want to be a little bit conservative. So hence that position, growth v defensive, and government bonds back into the portfolio.
Right. Drew, thanks to both gentlemen. I might bring Toby back in. But yeah, great conversation. So I really appreciate you guys actually giving your time. Very much appreciate it. So.
Thank you very much. And Andrew touched on this in the willingness of others to share. Today's been an excellent example of that. We've had Paul as a moderator, and he's coming back again on Wednesday and Friday. But to Andrew and Scott, thank you very much for the advice and guidance that you provided and the benefits of your experience. So to those of you who joined us today, thank you very much. We look forward to taking a different approach on Wednesday when we talk about building wealth management from an accountancy base. We'll have two very interesting presenters, Michael Rees-Evans, who's joined William Buck as a director very recently, and gone into a large multi-state, multi-office environment, and Matthew Walker, a partner in WLM, an accounting practice, who's taken the opportunity of the financial planning and advice business that they developed to develop a formal wealth management business in dynamic asset consulting with Jerome Lander. And then on Friday, we'll try and draw these threads together in thinking about the strategic issues for wealth management. So I look forward to you joining us then. So to Scott and Andrew, thank you very much for your time today. Paul, thank you for your excellent job in hosting today, and I look forward to speaking with you all again on Wednesday. Thanks very much.
Thanks, Toby. Thanks, Andrew. Thanks.
Bye.